Hello everyone. Today we are going to talk about the purchase cycle, also known as procure to pay or P2P. This is one of the most important business cycles because it controls how a company spends money. So even if you are not from an accounting background, you have probably experienced this cycle whenever a company buys something and later pays for it. Definition and importance. So, at a basic level, the purchase cycle records how a business buys goods or services and pays its suppliers. This cycle covers everyday activities like buying stationery, raw materials, or professional services. Why it is important? Because it ensures company spending is controlled and that expenses and liabilities are recorded accurately. For example, if an office buys stationery on credit, that transaction flows through the purchase cycle. The purchase cycle is not a single action, it's a series of steps starting from requesting a purchase and ending with payment and review. So let's now go through each step one by one using a simple practical example. Step 1, Purchase Requisition. So, this is where everything begins. A purchase requisition is an internal request raised by a department when they need goods or services. At this stage, the focus is on confirming the need, quantity, specifications, and budget availability. It is prepared by the user department and approved by management to prevent unauthorized purchases. For example, the maintenance department requests 50 units, 50 electrical cables costing AED 40 each, basically 40 dirham. So, from an accounting point of view, there is no general entry here because this is only an authorization and not a financial transaction. Then comes the step 2, supplier selection and quotation. Once the request is approved, the company looks for suppliers. Usually, 2 or 3 quotations are obtained and compared based on price, quality, delivery time, and credit terms. This step supports cost control and transparency. In our example, supplier B is selected because it offers the best balance between price and quality. You can see that supplier A has given rate of 42, so it equals to total of 2100. Supplier B has given rate of 40 for 50 cables, which has given us rate of 2000, and supplier C has given 39 dirham. Although this is less than 40, but he has also stated that he will be giving us no warranty, so we have not selected the lesser amount. So here we have selected, for that reason we have selected supplier B. Again, from an accounting perspective, no general entry is recorded because the transaction hasn't happened yet. Okay, third step is the purchase order issuance. So the purchase order, or shortly known as PO, is the first formal document sent to the supplier. It clearly states the quantity, price, delivery terms, and payment terms, and it creates a legal commitment. This document becomes very important later for invoice matching. In our example, a PO is issued for 50 cables at 40 dirham each with 30 days credit. Still, no accounting entry is recorded because no goods have been received yet. Fourth step is receipt of goods and services. This step confirms that the goods have actually arrived. When goods are received, they are checked for quantity and quality against the PO, and a goods receipt note or GRN is prepared. If there are differences, they must be reported immediately. In our example, all 50 cables are received in good condition. If the company uses a perpetual inventory system, inventory is debited and goods received, not invoiced, is credited. If periodic system, entry may be deferred until invoice. This recognizes that goods are received even though the invoice hasn't arrived yet under perpetual inventory system. Okay, last is the supplier invoice. Next step is the supplier invoice. Yes. So after delivery, the supplier sends an invoice. This invoice is matched with the PO and GRN, and this process is called three-way matching. So this control prevents overbilling, duplicate invoices and incorrect pricing. Here, VAT is also recognized and a legal liability is created. So, the accounting entry records inventory or purchases, VAT input and accounts payable. So, you see that here the invoice amount was 2000, as you can see here and here. So the invoice value is 2000, VAT is 5%, which is 100. So total invoice is 2100. So you see that the general entry here is purchase inventory is debited since it's an asset account and or under an expense account, and then the VAT input is also debited and accounts payable is credited. Okay, let's move to the step 6, recording in accounting system. Next, the invoice is entered into the accounting system, such as an ERP or an accounting software such as like Odoo or QuickBooks. Accounts are properly classified, due dates are recorded, and supplier balances are updated. This step directly affects expenses, VAT recoverable, and liabilities, and ultimately impacts financial reporting. So, expense account, electrical supplies expense, supplier balance is updated to 2100 dirham, payment due in 30 days. What would be the accounting impact? As I have told you before, expense is increased, VAT recoverable will increase, and liability has also increased. Okay, the next step is payment to supplier. But this step includes, once the invoice becomes due, payment is made to the supplier. So you see the liability here, this is the payment pending to the supplier. So payment must be properly authorized and matched to the approved invoice. This reduces the outstanding liability. In our example, after 30 days, since the credit term was 30 days, as I told you before, the company pays AED 2100 by bank transfer and accounts payable is cleared. So you see accounts payable is getting debited here and bank is getting credited with the 2100 amount. Okay, and this brings us to the last step, which is reconciliation and review. This is the final step. Supplier statements are compared with company records to ensure balances match. This helps identify missing invoices or duplicate payments or errors. There is no accounting entry here. This is purely a control and review activity, especially important during month end closing. So the supplier statement should show balance of 0. The company ledger balance should also be showing balance of 0. Okay, so this is very much of how the purchase cycle operates. Now, coming to the financial statement impact. So, overall, the purchase cycle affects expenses, inventory or VAT, and liabilities. And in the statement of cash flow, it goes under cash outflow under operating activities. So, any weakness in this cycle can directly distort the financial statements. So, internal controls, risk and errors. Strong internal controls are critical in the purchase cycle. These include authorization at each stage, three-way matching like of PO, GRN and invoice. All the entries here should match. Segregation of duties and using an approved supplier list. What are the common risks? Common risks include unauthorized purchases, duplicate invoices, incorrect VAT, and payments without approval. So, for example, the person ordering the goods should never be the same person approving the payment, or same invoices must not be paid twice due to weak underlying controls. What would be the audit perspective? So, from an audit perspective, auditors focus on whether liabilities are complete, expenses are valid, and VAT claims are accurate. They perform procedures like vouching invoices to PO and GRN, supplier confirmations, analytical reviews, and cutoff testing. So, to summarize, the purchase cycle is an end to end process from request to payment and review. It controls costs, prevents fraud, ensures accurate financial statements, and supports audit readiness. A well designed purchase cycle protects both the business and its stakeholders. So, that was very much it for the purchase cycle. Thank you so much for your time. See you in the next one. Till then, take care. Bye.